Welcome back to Talk Tickers, the deep dive, where we break down corporate earnings calls for you, the retail investor.
Yep, getting right into the raw audio and transcripts so you don't have that.
Exactly. And today we have a really interesting one. We are looking at AutoZone, ticker symbol ZO.
Right, their Q3 2026 earnings conference call, which just happened yesterday, May 26th, 2026.
Yeah, and you look at a traditional retail investment today, and there's this baseline expectation of like high voltage excitement.
Yeah, for sure. Everyone wants AI hardware or, the next big tech ecosystem.
Right. You want to buy a stake in the future. It has this flashy appeal. But then you pivot to automotive replacement parts.
It's not exactly flashy.
No, not at all. I mean, the immediate image is like harsh fluorescent lighting, the smell of vulcanized rubber, and, someone buying wiper blades for a 2012 Honda Civic.
Yeah, it's historically treated as this completely sleepy, supposedly recession-proof corner of the market.
Exactly. But looking through the transcripts from yesterday's call, it becomes really obvious that this sleepy storefront vibe is just a total facade.
It's completely a facade. What looks like a neighborhood parts shop is actually masking this hyper-aggressive, incredibly sophisticated logistics network.
So let's just get right into it. Is this just another boring quarter of selling motor oil, or is there a bigger engine driving this stock right now? Let's start with the headline numbers.
Yeah, let's talk top-line revenue because it's massive. They pulled in $4.8 billion in total sales for Q3.
Wait, $4.8 billion just in one quarter?
Just in one quarter, and that is an 8.4% jump from the exact same quarter last year.
Wow. I mean, in physical retail in 2026, seeing an 8.4% jump is basically unheard of.
It really is. Most legacy brands are fighting tooth and nail for like 1% or 2% growth just to keep the lights on.
Right. So 8.4% is staggering. Did management say anything about that specific number?
Oh, they definitely did. They were very proud to point out that this is their biggest percentage increase in revenue in over 3 years.
Okay, but couldn't they just be opening a ton of new stores to artificially boost that number? Like just adding square footage?
You'd think so, but no. If you look at the same store sales, the domestic comps, they came in at a solid 4.1%.
Okay, so they're squeezing 4.1% more sales out of the exact same square footage year over year.
Exactly, which implies they have serious pricing power, and the demand is just incredibly resilient right now.
But, looking at the profitability metrics, the narrative gets a little messy.
Yeah, it gets a lot messier.
Let's look at earnings per share. EPS came in at $38.07, which is a 7.7% bump.
Right. Solid on the surface.
Yeah, solid. But management spent like an inordinate amount of time on this call playing this weird what-if game.
They really did. They were practically begging the street to acknowledge that their EPS would have been up 12.5% if it wasn't for this LIFO charge.
A $20 million non-cash charge tied to LIFO inventory accounting.
Yep. The dreaded LIFO penalty.
Okay, so whenever a management team tells the market to just, look past a massive cost because it's a non-cash accounting rule, I get highly skeptical.
As you should. It always warrants heavy scrutiny.
Right. So Can you translate this for us? Why is an accounting rule dragging down their headline profit and sure investors actually care, or just ignore it like management wants us to?
Well, management loves using that non-cash phrasing to soften the blow, but you can't just ignore it. LIFO stands for last in, first out.
Okay.
And it is an inescapable reflection of their operating reality right now. They're in an environment where the cost to manufacture, steel parts, molded plastics, and transport heavy goods has just climbed steadily.
Right. Inflation.
Exactly. So to illustrate the mechanics in plain English, let's say AutoZone buys a pallet of alternators in January for $100 a unit.
Okay, $100.
But then supply chain inflation pushes their wholesale replacement cost for that exact same alternator up to $120 by May.
Ouch.
Right. So the LIFO accounting standard basically requires them to record that new, higher $120 cost of goods sold when a customer walks in and buys an alternator today.
Wait, even if they're physically handing the customer the older alternator they bought back in January for $100.
Yes, exactly. That's the kicker. It artificially compresses the paper margin on that specific transaction.
Wow. Because they have to keep these historical cost layers on their balance sheet.
Yep. And as inflation keeps driving the current replacement costs higher and higher above those old baselines, they're forced to take these LIFO charges to essentially true up the value of their inventory.
So it's basically ensuring they don't overstate their profitability during a highly inflationary cycle.
Exactly. It's keeping them honest, but it creates a major structural pain point right now.
I'll say. And the CFO, Jameer Jackson, He quantified this, right?
He did. He noted that the LIFO charge alone created a 77 basis point drag on their gross margin.
Oh, wow.
Yeah, pulling the overall gross margin down to 52.2%.
I mean, a drop of nearly 0.8% in retail gross margin is usually enough to send Wall Street analysts into an absolute panic.
It usually is, but here is where you have to look at the story behind the numbers. If you extract all that LIFO accounting noise, their core merchandising margin actually went up by 20 basis points.
Oh, really?
Yeah. So operationally, they're demonstrably squeezing more efficiency out of their supply chain and their pricing strategies.
Okay, so the accounting rules are penalizing the headline number, but the actual physical business of moving parts is getting more profitable.
Exactly. That 12.5% adjusted growth rate they kept pointing to, it really is a cleaner reflection of the actual physical volume going through their system.
Got it. So the core engine is running hot. But to understand the fuel source, we have to talk about this massive bifurcation in their sales mix.
Yes, the tale of two AutoZones.
Right, because they are essentially running two completely different businesses under the same roof right now.
They really are. You have the legacy business, which is the DIY or do-it-yourself segment.
The traditional retail model. You know, the everyday driver walking in on a Saturday to buy some antifreeze or car wax.
Exactly. And that DIY segment, it only grew by 2.2% this quarter.
Which is barely keeping pace with inflation, frankly. It's a super mature, saturated market.
It is. But then you look at the other side of the store, the commercial segment.
The do-it-for-me side.
Right. They are acting as a B2B distributor here, selling parts directly to local independent repair shops, professional mechanics, and national fleet operators.
And that segment absolutely exploded.
Oh, it went wild. It grew by 10.4%.
10.4%.
Yeah. Commercial now accounts for roughly 34% of their total domestic part sales.
Think about that. A third of their entire U.S. business is happening out the back loading dock.
Yep. Completely bypassing the retail cash registers.
It's wild. But why is this happening now?
It's the result of a deliberate multi-year strategic pivot. And it's driven by the changing nature of the automobile itself.
Because cars are just getting way too complex.
Yeah, exactly. Vehicles are getting exponentially more complex. The era of the driveway mechanic diagnosing engine misfires on a Sunday afternoon, that's fading rapidly.
Oh, completely. You pop the hood of a 2022 vehicle, and you can barely even see the engine block beneath all the plastic cladding.
Let alone actually access the components without proprietary diagnostic software. Modern vehicles are basically rolling, locked-down computer networks.
Right. So when a sensor fails, the average driver has zero capability to fix it. They have to take it to a pro.
They're forced to. And AutoZone saw this structural shift coming. They realized that to maintain any real growth, they had to capture the professional mechanics business.
But breaking into that B2B space has to be incredibly difficult. I mean, local mechanics already have deeply entrenched relationships with specialized distributors.
Oh, yeah. Regional jobbers or competitors like Advance Auto Parts and O'Reilly. You can't just roll up in a red pickup truck and win their loyalty overnight.
So how are they doing it?
Yeah.
How are they stealing this local market share?
You have to offer a logistical advantage that the incumbents simply cannot match. And for AutoZone, that advantage is the mega hub strategy.
The mega hubs.
Yeah.
This is the driving force behind that 10.4% commercial growth.
It absolutely is. The CEO, Phil Danielle, detailed that they rolled out 14 new mega hubs this quarter alone.
Which brings the nationwide total to 156.
Yep. 156. And to really grasp the competitive moat this creates, you have to think about the physical constraints of a standard retail auto parts store.
Like your typical neighborhood AutoZone.
Right. A standard store might carry maybe 20,000 to 25,000 unique SKUs.
Okay. Which covers the fast-moving stuff. Standard batteries, generic brake pads, common filters.
Exactly. But the commercial business isn't built on common filters.
Right, because when a local mechanic has a 2018 Volkswagen Tiguan taking up space on one of their hydraulic lifts, and it needs some highly specific, obscure fuel pressure regulator.
That neighborhood store is completely useless.
Yeah. And for a professional mechanic, that hydraulic lift is their primary revenue-generating asset.
Yeah. 100%. Every single hour, a car sits paralyzed on that lift waiting for a part. The shop is literally burning money and turning away the next paying customer.
So the speed of acquiring the part dictates the shop's entire profitability.
Exactly. And this is where the Mega Hub steps in. It operates like a massive vascular system for the region.
So what is a Mega Hub physically?
It is a massive, localized warehouse disguised as a superstore. We are talking about facilities holding over 100,000 unique SKUs.
Wow. 100,000.
Yeah, they stock the slow-moving, rare, incredibly complex components that regional competitors just cannot afford to keep on their local shelves.
So it's a hub-and-spoke distribution model.
Exactly. AutoZone drops a mega hub into a dense geographic market, and it acts as the central heart, pumping inventory to dozens of smaller satellite stores.
So when that independent shop needs that weird Volkswagen regulator, the local store pings the mega hub, it gets loaded onto a delivery vehicle, and it reaches the mechanic in, under an hour?
Under an hour. By placing 100,000 parts within a localized 60-minute delivery radius, AutoZone can look a shop owner in the eye and guarantee availability.
That is a massive advantage. They are basically out-inventorying the local competition.
Yes, they are weaponizing their balance sheet to hoard wear parts closer to the end user than anyone else in the industry.
And there's a secondary economic benefit here, too. By planting a mega hub, it actually lifts the overall DIY sales for the entire surrounding satellite network.
Oh, absolutely, because the retail customers suddenly gain access to that huge expanded inventory pool through same-day store transfers.
Right. So management wants to eventually hit 300 of these mega hubs, right?
That's the stated goal, and sitting at 156 today means this commercial growth engine has years of physical expansion runway left.
Years before it hits saturation. Okay, so the mega hubs are the fundamental driver. But reading through the transcript, I notice a massive macroeconomic tailwind that artificially inflated these headline numbers.
Oh, you mean the currency tailwind?
Yes, and it had absolutely nothing to do with selling auto parts. The Mexican peso.
Yeah, it's a massive, often overlooked data point.
Because AutoZone has a huge footprint south of the border, right? Like 933 stores in Mexico.
Yeah. And the CFO explicitly noted that the peso strengthened by nearly 13% against the US dollar compared to Q3 of last year.
Okay, so wait. Foreign exchange translation for an auto parts store? How much did this actually matter?
It matters a lot. It's one of those macroeconomic quirks that can dramatically distort how strong a quarterly report looks.
So when an AutoZone in Monterrey sells a battery, the transaction happens in pesos. The revenue is recorded locally in pesos.
Right. But as a publicly traded U.S. entity, AutoZone has to convert that aggregate revenue back into U.S. dollars for Wall Street.
And because the peso appreciated by 13%, it takes fewer pesos to buy a single U.S. dollar.
Exactly. So without selling a single additional battery or raising prices down there, that exact same volume of Mexican sales magically translates into a much higher U.S. dollar figure.
It's literally free money on the income statement.
It is. The CFO quantified this currency swing as a $74 million benefit to top-line revenue.
$74 million.
Yeah, and a massive 83-cent boost to their earnings per share.
83 cents. Okay. When you look at the total reported EPS of $38.07, carving out 83 cents purely as a foreign exchange artifact, that is highly material.
It really is. Now, management was completely transparent about the math, which is good, but investors have to mentally compartmentalize that windfall.
Because currency markets are notoriously volatile, right?
Exactly. A 13% tailwind this year could easily reverse into a 15% headwind next year if the geopolitical or economic climate in Mexico shifts.
Right. It's a temporary injection of capital, not a structural improvement in how they sell parts.
Exactly.
Okay, speaking of temporary factors, I really want to push back on something management said about demand. Let's look at the drop-off at the end of the quarter.
Ah, yes. The weather excuse.
Yes. The cadence of their domestic sales started strong, but over the final 2 weeks of the quarter, DIY comps plunged down to 1.3%.
Right.
And management immediately pointed to the sky. They blamed unseasonably cool and wet weather for hurting their AC and battery sales.
They leaned on that pretty hard.
Look, I read earnings transcripts from apparel brands, home goods, restaurants. Every single retailer blames the weather when sales dip.
Oh, it's the oldest excuse in the corporate playbook.
Exactly. It's usually smoke and mirrors to mask weakening consumer demand. So is this a legitimate excuse for AutoZone, or is this a red flag that demand is actually cracking?
It's a great question. Skepticism is the correct default response when a CEO starts talking about meteorology. But, and this is a big but, the automotive aftermarket operates under different physical constraints than, say, a clothing retailer.
How so?
Weather is a highly correlated mechanical demand driver for this specific industry. It operates on the thermodynamics of automotive failure.
The thermodynamics of automotive failure. Okay, explain that.
Well, think about a car battery. It's essentially a volatile chemical reaction contained within a plastic box.
Right.
When you experience a mild, comfortable spring with moderate temperatures, that chemical reaction is completely unstressed. The battery doesn't undergo sulfation from extreme heat, and it doesn't struggle to deliver cold cranking amps in extreme cold.
So the mechanical components just survive the season intact.
Exactly. Furthermore, if a region experiences weeks of 65-degree rainy weather in May, drivers simply do not turn on their air conditioning.
Oh, that makes sense.
Right, so they remain completely unaware that their AC compressor actually seized up over the winter, or that they have a massive refrigerant leak.
Because they haven't tried to use it yet. The parts simply do not fail, or the failures just go unnoticed.
Precisely. AutoZone's fundamental business model requires the catastrophic breakdown of mechanical systems. Extreme weather events, whether it's a polar vortex in January or a blistering heat wave in July, those are the catalysts that force systems to fail.
And they fail simultaneously across an entire geographic market.
Yep. When the weather is benign, the cars don't break and foot traffic vanishes.
Okay, so the CEO pointed to historical data showing that markets that are traditionally warm by May stayed unusually cool, which directly correlated with a drop in battery and AC sales.
Right. The mechanical logic actually holds up here.
It does hold up, but it paints a really precarious picture for their management guidance heading into Q4, because they are openly relying on meteorological forecasts to bail them out.
Oh, they totally are. The CEO literally stated they are expecting a normal to hotter than normal summer based on forecasters.
Banking on a heat wave to drive Q4 revenue is a vulnerable position, man.
It really highlights the captive nature of the industry. You can build the most sophisticated logistics network in the world, deploy 150 mega hubs, optimize your labor, but you are still tethered to the climate.
That's wild. But management's counterargument is that the underlying structural fundamentals provide a massive floor for demand, regardless of the weather.
And the most critical fundamental there is the age of the U.S. vehicle fleet.
Right. The average car on the road right now is over 12.5 years old.
Which is incredibly old historically.
Yeah. New vehicle prices are completely out of reach for the median consumer, and financing rates on used cars are still punishingly high.
So consumers are economically trapped. They have no choice but to repair their aging 2013 sedans.
Which forces them directly into the AutoZone ecosystem. Okay, but let's look at the macro environment shifting. The CFO noted they expect the average ticket, how much a customer spends per trip, to drop into the mid 4% range for Q4.
Right, down from 5.6% this quarter.
Why is it decelerating?
Because AutoZone is finally lapping the severe inflation spikes from the previous year.
Lapping the inflation. So the year-over-year comparables are becoming mathematically difficult.
Exactly. If a gallon of synthetic oil jumped from $20 to $25 a few years ago because of supply chain chaos, that 25% price hike made their revenue growth look phenomenal.
But now in year 3 of this inflationary cycle, that oil might only increase from $25 to $26.
Right. Prices remain elevated, but the aggressive rate of growth has collapsed. The inflation tailwind that was artificially padding their top line is dying down.
And as that inflation mask slips, it reveals a concerning metric hidden in the DIY data. While the average ticket size grew by 5.6% this quarter, the DIY traffic count, the actual volume of human beings walking through the doors, was down 3.6%.
Yeah, that is the critical tension point for the entire retail sector right now.
Because for the past 2 years, companies could endure shrinking foot traffic because the unit price of every item sold was skyrocketing.
They masked the loss of customers with aggressive pricing power.
But if inflation cools and they can no longer push 6% or 7% price hikes onto the consumer, that negative 3.6% traffic metric is going to violently slam the brakes on revenue growth.
They're going to have to pivot back to fighting for genuine volume growth, literally just getting more cars into the parking lot.
Okay, and while inflation is cooling on the consumer side, the historical damage of that inflation is going to continue punishing their income statement via LIFO.
Management was very clear about that in their guidance. They warned that Q4 will incur another LIFO charge, estimated at $30 million.
$30 million. So that will artificially drag down gross margins by an additional 45 basis points.
And shave about $1.40 off their Q4 earnings per share.
Okay, wait. Why is the LIFO penalty expanding if inflation is cooling?
Because they are churning through inventory at a rapid rate, driven by that 10.4% commercial growth. They're digging deeper into those historical inventory layers.
Forcing the recognition of higher replacement costs against current margins.
Exactly. It's a deferred accounting pain. It will continuously suppress their headline EPS until global supply chains undergo actual deflation, not just a deceleration of inflation.
Okay, so the margin pressure from LIFO is an accounting reality. But I want to push back on something structural here. Isn't there a much more severe threat to their profitability hidden in this strategic pivot?
You're talking about the margin squeeze from the commercial mix.
Yes. The math on this mix shift seems undeniable. The B2B commercial business operates at a drastically lower gross margin than the retail DIY business. Right.
Oh, drastically lower. Because when a professional mechanic orders a set of ceramic brake rotors, they demand wholesale pricing and volume discounts.
Because they are operating their own business and need room to mark up the part for their end consumer.
Right. But when a DIY customer walks in off the street to buy that exact same rotor, AutoZone captures the full retail markup.
Right. So the CFO explicitly acknowledged this, calling it a mix drag that cost them 22 basis points on their gross margin this quarter.
Yeah, he did.
So my question is, if the low-margin commercial segment keeps growing at 10.4%, while the higher-margin DIY segment only grows at 2.2%, doesn't that mean AutoZone's gross margins are doomed to slowly compress forever?
Well, mathematically, yes. As commercial becomes a larger piece of the total pie, the margin percentage must decline. They are essentially growing themselves into a structurally lower margin profile.
So how do they survive that compression without the stock tanking?
They have to abandon the fixation on margin percentages and focus purely on operating profit dollars.
Meaning volume.
Exactly. Yes, the margin rate on a commercial transaction is heavily compressed, but the sheer velocity of purchasing is massive. A DIY customer might buy one battery every 4 years. A commercial shop might buy 12 batteries a week.
You accept a thinner slice of the pie, but you consume hundreds of pies.
That's a great way to put it. Maximizing gross profit dollars through volume is their primary defense. But the secondary defense requires ruthless internal efficiency.
They have to extract pennies from everywhere else.
Yep. A major component of this is driving higher penetration of their private label brands, primarily Duralast.
Ah, Duralast. Because by controlling the manufacturing and cutting out the middleman, they capture a wider margin compared to selling national brands like Bosch.
Exactly. They also have to optimize global freight routing, aggressively manage store-level labor hours.
Yeah.
It puts immense pressure on execution.
Right, because if they stumble on private label adoption, or if supply chain logistics bottleneck, that commercial margin drag will instantly bypass their defenses and crush their net income.
They can no longer coast on the fat retail margins of the past. The whole enterprise has to operate as a hyper-efficient machine.
Okay, so bringing this all together for the bottom line, taking in the top line beats, the commercial growth, the LIFO noise, the margin compression, what is the ultimate verdict here? Bullish or bearish?
Based on the underlying mechanics and the deployment of capital, my stance is cautiously bullish.
Cautiously bullish. Break that down for us. Why the bull case?
The bullish thesis is anchored in the sheer physical dominance of the mega hub strategy, sustaining 8.4% top-line growth by physically bullying regional competitors out of the market with these 100,000 SKU warehouses. It creates an incredibly deep moat.
Right. They're aggressively taking market share in a fragmented B2B industry. And they have that macro tailwind of a 12.5-year-old vehicle fleet forcing people to repair instead of replace.
Exactly. The caution, however, is entirely tied to the margin profile. Investors have to possess the stomach to endure sustained gross margin compression.
Because the pivot to commercial mathematically dilutes the margin rate.
Yep. Combine that mixed drag with the persistent LIFO charges making the EPS optics look volatile, and you have a scenario that will really test the patience of analysts who only look at headline profitability percentages.
Right. You have to look beneath it. Let's give some actionable advice for you, the listener. If you are already holding AZO right now, what should you do?
Honestly, sleep easy. The cash generation is the true North Star for anyone holding this stock.
Yeah, the free cash flow numbers were absurd. They generated $1.1 billion in free cash flow year to date.
That is actual unrestricted cash sitting in the bank after every operating expense, mega hub construction cost, and supply chain investment is fully funded.
And what do they do with all that cash? They don't pay a dividend, right?
No dividend. They execute one of the most aggressive, relentless share buyback programs in the history of the modern market.
Oh, it's wild. This quarter alone, they bought back $586 million of their own stock.
Yep. And the historical context of this buyback program is just a masterclass in financial engineering. The CFO noted that since the program started in 1998, they have bought back over 100% of their original outstanding shares.
Wait, Over 100%. So they have literally retired the entire initial float of the company.
And then some. Just by systematically vacuuming up shares from the open market decade after decade.
So by continuously shrinking the denominator, the total number of shares outstanding, they mathematically force the earnings per share to grow, even if net income stays flat.
Exactly. That massive perpetual wave of free cash flow acts as a permanent structural bid underneath the stock price. Management is fiercely protective of shareholder value.
So if you hold the stock, you just allow that compounding buyback machine to consolidate your ownership stake over time.
Precisely. Now, what about potential buyers looking to start a position?
For potential buyers, you have to realize you are no longer buying a simple retail store selling car wash soap. You are buying a commercial logistics network.
So don't obsess over DIY comps.
Right. Watch the mega hub rollout. They want to hit 300 eventually. Monitor how quickly they deploy capital to open new hubs and how rapidly those hubs generate double-digit commercial growth. As long as they keep capturing B2B market share, the thesis holds.
It's the true engine of the stock.
All right, so we've translated the Wall Street speak and we've found the real engine driving AutoZone. The transition from a sleepy retail footprint into a localized B2B distribution powerhouse is the defining narrative here.
It's a textbook execution of adapting to a structural shift in consumer behavior.
It really is. But before we wrap up this deep dive, I want to leave you, the listener, with a final massive structural shift I'm all over. Something management completely avoided discussing on this call.
Oh, this is the big existential threat.
AutoZone's entire 10.4% commercial growth engine, the mega hubs, the supply chain, it all relies on older, traditional gas-powered cars breaking down.
Internal combustion engines.
Right. The business model requires thousands of moving metal parts, high-pressure fluids, serpentine belts, and intense kinetic friction to eventually fail.
The current aftermarket is built entirely on the thermodynamics of combustion and friction.
But as electric vehicles, which have significantly fewer moving parts, continue to age into the secondary market over the next decade, what happens?
The architecture of an EV is a complete destruction of the traditional servicing paradigm.
Exactly. There is no motor oil to change. There are no alternators to fail, no spark plugs, no timing belts.
Even the brake pads last exponentially longer because of regenerative braking. The sheer volume of consumable parts required collapses.
So the question you need to ask yourself is, in 10 years, when an aging 2024 EV rolls into a local mechanic shop, will AutoZone's 100,000 SICU mega hubs be stocked with the right high-voltage electronic components and proprietary sensors to service it?
Will they be able to capture the commercial margin on EV repairs?
Or is this massive 10% commercial growth engine built entirely on the internal combustion engine eventually going to run out of gas?
Navigating that transition will be the ultimate test of their adaptability.
It's a profound structural question to consider the next time you walk past that harsh fluorescent lighting. Thanks for joining us on this deep dive. See you next time.